Okay, problem 12.1a is the Lansing Corporation. And this is our first cash flow problem. Let me give you a quick overview of the problem with cash flows. This is the copy of their income statement. This is taken right from the text on page 575. And let's take a look down at their income statement. Sales revenue. Not all of that is in cash. As a matter of fact, in some businesses, none of that is in cash. Cost of goods sold is a computed expense. We're going to talk about that in a few chapters. That's basically your beginning inventory plus your purchases minus your ending inventory is your cost of goods sold. No guarantee you bought cash, you paid cash for the goods, that you don't still owe for them. So that really isn't cash. Depreciation expense we know is not cash. Salaries expense, some of that's cash, but some of that could be salaries payable. Same with rent expense, insurance expense, interest expense, and utilities expense. As a matter of fact, all of these have the additional complication that they could have been prepaid last year and showed up as an expense this year. So we have net income of $6,000, but that doesn't tell us anything about cash. We're going to start with that. We're going to make some adjustments for depreciation expense, and then we're going to go look at the balance sheet and make some more adjustments. So, started with the $6,000. The only thing you can tell me right now about that $6,000 is that some, all, or none of it is cash, which is not very useful information. So, we have depreciation. We know that's not cash. So we're going to add that back. We're going to add back that $12,000. We don't need anything else on this sheet. Everything else we need is on the balance sheet. Now, did we have any gains or losses? Gains or losses are reported here. No, there are no gains or losses, so we don't have to worry about that. So let's take a look. This is the balance sheet. Our accounts receivable was $5,800. It is now $5,600. So accounts receivable went down $200. So cash went up $200. People paid us that owed us money. Inventory was $1,540, is now $1,980. So inventory went up by $440. Assuming that you don't steal the inventory, you had to pay for it. So that means cash had to go down $440. Accounts payable. We owed last year $4,600. This year we owe $4,400. Well, again, using common sense, what makes bills go away? You pay them, and when you pay them, your cash goes down. In this case, $200. Salaries payable. We took the salary expense, but we didn't pay it. So our salaries payable went up by $880 or $180. Therefore, our cash, the amount we didn't spend, had to go up by $180. You're starting to get a feel for how this works, okay? And if you looked at the video, I called this the compass, and we'll review that in just a second. Our utilities payable, same logic, went up by $60. We took the expense, we didn't pay it, so the cash goes up. prepaid insurance went from prepaid insurance went from 280 to 260. So prepaid insurance was 280, is now 260. So we paid that before. So our cash for this year goes up. And last but not least, our prepaid rent was 180, is now 220. In other words, we bought more prepaid rent, so our cash went down $40. So they're the adjustments we're going to make. So we have our accounts receivable went down 200, so we're going to add that. So we're going to add the $200. Our inventory went up, so our cash had to go down, so we're going to subtract $440. Our accounts payable went down. We paid $200 of our bills, so our cash went down. Our salaries payable went up, therefore our cash went up. Our utilities payable went up, so our cash went up. And then we have our two prepaids. We have prepaid rent and prepaid insurance. Our prepaid rent went down. Our prepaid rent, went up by $40,000. So our cash had to go down by $40,000 or $40, not $40,000. Excuse me. And decrease in prepaid insurance. Our prepaid insurance, our insurance expense this year included $20 that we paid in a previous year. So our cash went up by that $20. So we have a total of $11,780 in total adjustments. That comes to $11,780 plus the $6,000 we started with. Our cash at the end of the year, grand total $17,780. Remember, we're simply looking at what in the cash flow video we called the compass. And just a quick review, we started out with the accounting equation, assets equals liability plus equity. We then broke that in the assets into two piles, cash plus non-cash assets equals liabilities plus equities. Then we're just going to do a little bit of algebra here. Cash equals liabilities plus equities minus non-cash assets. And then we're going to make that a dynamic equation by simply inserting the lowercase Greek letter delta. And that's read that the change in cash varies directly. The change in cash varies directly with the change in liabilities, varies directly with the change in equities, and varies inversely in the opposite direction. Notice the minus sign, in the opposite direction of non-cash assets. And then we just applied that to our balance sheet. And when we looked, our accounts receivable was 58. It's now 56. That's a non-cash asset. So accounts receivable went down, cash went up, opposite direction. And just walk through the entire list the same way.